So good morning, everyone, and welcome to our E2E reception in partnership with finnCap, finnCap Group. This is the latest, as many of you will know, in the Unfiltered series. We've been running this series for quite a while now, from the beginning of the year. And the whole idea is, although it's quite difficult to get people together, we want to make today and all of our receptions as interactive as possible, enabling our community to hear from the great speakers and learn from these sector-leading companies. Today, we'll try and keep it, we're not on LinkedIn Live, we'll keep it under Chatham House rules. My name, for those of you that don't know me, I'm Shalini Khemka. I'm the Chief Executive of E2E. There's a lot of people here who are joining that I have to give credit to for helping me start this organization, and we've just recently celebrated 10 years. And this morning, I'm very excited to have friends with me as our speakers. I hopefully have heard of all of them. These are amazing entrepreneurs and also an amazing business leader called John Farrugia. So I'm just going to say who they are quickly. And Robert, if you could just raise your hand so they can see you, so we've got a lot of people. Robert Kilgour, you'll always know him because if you ever look for loud suits or loud glasses, you will know which one Robert is. So Robert, thank you very much for joining us. Cecile, the forever beautiful, very talented Cecile Renaud. Cecile, can you just raise your hand?
Yes, hello.
Thank you very much. And Tim Weller, who's a family friend for a very long time. Tim, thank you for joining us. We were just talking about this amazing bike ride he's completed for charity with the British Asian Trust. So you might mention that a little bit about it in a bit, Tim, but I want to congratulate you for cycling. I think, was it 4 days, 400 kilometers, if I'm right?
That's right. Yeah, that's right.
Really well done. So he's going to talk to you about his business and also how he's, I think, gone from a size 14 to a size 6. So I'm teasing you, Tim. Tim, thank you very much for joining us. We'll draw upon their combined business experience to talk about some of the biggest decisions that we as founders have to make in our lives, which is really, do we sell? Or do we raise money? When's the right time to exit? When's the right time to fundraise? What's the right strategy to go about making those decisions? Do you sell some equity in your company? What do you do with the management team? Is it best to exit, or should we keep going on? So what are the factors that they weighed up when they made these decisions, and what lessons did they learn along the way? And what can they share with us this morning? So we're hoping to extract as much knowledge and some of the secrets that you might not hear on the usual webinars and events. So Tim, Robert, John, and Cecile, please do bear that in mind. We want to know some of the things you might not hear publicly. Joining me on this interesting journey today is also an amazing business leader. His name is John Farrugia. Sean, would you be able to raise your hand? So John is the managing partner and he's the head of technology at finnCap Cavendish. Today, I'm also pleased to announce and celebrate our partnership. We're launching our partnership with finnCap Group. So if you are looking to raise money, if you are looking for an exit, we would encourage you to talk to us and we will make the right introductions. It's quite a big business. We will make the right introductions within finnCap around those decisions that you need to make. So regarding this morning's format, I'm going to first of all introduce John, who's going to tell us about finnCap and how they help with our business goals. I'll then introduce our special guests, and we'll have a series of brief discussions about their business journey and their general and go into a general discussion after that. So in terms of making it interactive, what I'd encourage you to do is I'll kick off the Q&A with all of them, but please feel free to interrupt me. Use the function to raise your hand. You should see the function at the bottom. Just raise your hand or use the Q&A. And a lot of people, thank you very much. You have your cameras on. So we're going to maximize the opportunity to make it as interactive as possible. So before we start, for a few people who are new today, who've not met E2E before, I'm just going to summarize it really quickly. We're all about enabling extraordinary entrepreneurship. It stands for Entrepreneur to Entrepreneur Exchange. The quickest and easiest way to describe us, and I think some of my board love this, and Tim, I don't know what you're going to think about it, it's Match.com for business. So if you want to meet the right people, quality people who are growing entrepreneurs, scaling their businesses, and those who have done it, you swipe right or you swipe left, and hopefully you'll meet the right person, and it is for business. I know that certain people from our community have had relationships, personal relationships, nothing wrong with that, but this is all about entrepreneurs connecting. So in addition to the entrepreneurs connecting, we help companies raise money. We're pleased that we supported a company called Vashi, it's Profit Track number 9, with their 45 million fundraise recently. We help place non-exec directors onto boards of companies. There's a lot of people on today who are actually non-execs already or wish to be non-execs. If you wish to be, please do talk to us. And then separately, if you'd like to be a speaker at a future event and get involved in participating at an event, please do let us know. So we'd be delighted to hear from you. We know how expensive life is for entrepreneurs, so we've kept, and COVID has made life even more difficult, so we've kept complimentary membership. Many of you will know that we've also introduced premium membership. We've tried to keep the cost very low. That is about £25 a month, £300 a year. And I'm pleased to say that we've managed to convince IWG, it's taken a bit of convincing, that all of our premium members, they have unlimited access for free to all of the business lounges throughout the year. So if you are sort of working from home, needing access to business lounges for a premium member, it would normally cost you £80 a month. You can do the maths. At £30 a month, hopefully it makes our premium membership a no-brainer. In addition to that, I can see Lawson's on the call. I'm trying to see whether I can take Lawson out for lunch again and agree some additional membership benefits with City AM and all of that. So Lawson, thank you for joining us. He's shaking he's raising his hand now. So what we're trying to do with the premium membership is really make sure that we look at what founders need and add that to our portfolio of services. There's £24,000 of support right now, but take a look. So before we go into our guests and go into the nitty-gritty of today's conversation, I wanted to introduce John, and who's going to tell us a little bit more about finnCap. John, when you look at him, you won't realise, but he's got roughly 20 years of experience in corporate finance. John, you look much too young. And he's had some outstanding deal completions with an outstanding deal record within the technology and tech-enabled business services sector. Believe it or not, he's completed 50 corporate finance transactions, including M&A, sell-side, buy-side, leverage buyouts, public takeovers, public to private, and fundraising transactions. So I've touched on just his business with finnCap, but there's a lot more to him. So John, I'm delighted to be having the opportunity to host the event with you today, and I'd like to say thank you to you and to finnCap. And I'll ask you to say a few words about the business before I introduce our 3 speakers.
Well, thanks, Shalini, for the introduction. Yeah, as Shalini said, I've actually been in M&A now for 21 years. I quite often say that in my first meetings with people, as they say, they tend to not believe that I've been around for that long. Over that time, yes, you're absolutely right, Shalini. I'd like to think I've seen it all and worked on most types of transactions: buy side, sell side, minority deals, majority deals, debt deals, just pure equity deals. A bit about the finnCap group. So we combined 2 businesses combined years ago, finnCap and Cavendish, and what that really did was combine the private markets and the public markets together, and we've expanded since then as well. So as a group now, we're 150 people, and what we're effectively able to provide is a service to any growth company along that journey. It may be a company going through a nice growth phase, looking to raise 4 or 5 million or plus. It may be an entrepreneur who's 5 years, 7 years into their journey that says, actually, I need a bit of help. I wouldn't mind having a private equity firm on board, or I wouldn't mind finding a strategic to do an AV with. That's something this with. And quite often, some entrepreneurs get to the point where either they want to retire or they've received inbound approaches, and we deal with that too. So, you know, we look to cover the full breadth of M&A. So someone looking to do a full exit, or someone looking to find a buyer on an international basis through our international reach that we have in, I think it's 70 countries now. That's something we can assist with. So as a group, to sum it up really, as a group, what we're trying to do is provide services to growth companies at every stage of their life cycle. Hopefully that's a decent intro, Shalini.
Thank you very much, Sean. I really appreciate that. That's a great intro, and thank you for keeping it brief. I really appreciate it. So now on to introducing the three people who've kindly given up their time, hugely busy: Robert Kilgour, Cecile Renaud, and Tim Weller. I'll kick off with just introducing Robert. Robert's a good friend of E2E's. I'm also proud that he is an advisory board member and an investor in our company. As many of you know, he's an entrepreneur. He's an investor, he's a property developer, and he's a philanthropist. In 1988, he founded Four Seasons Healthcare, which grew to be the UK's 5th largest home care operator and he had one of the largest exits in the UK care home industry. Robert's currently the CEO of Dow Investments PLC. He's also the founder and executive chairman of Renaissance Care. So he exited, and like Tim, he went back in again, and he's launched Renaissance Care, which operates care homes throughout Scotland. He holds several other non-exec directorships, and I need a lot of time to go through them all. And he's a senior consultant and senior advisor in many different businesses, and he's an ambassador of Macmillan Cancer Support. So Robert, I've just touched on Renaissance and Dow. Maybe when you talk about yourself, you'll talk about some of the other amazing things that you're doing. And care homes is his real bread and butter. But I'm learning in our advisory board meetings, he's always challenging us. So I have to thank him publicly for that, because he always makes us think and move the business in strategically in stronger directions. So Robert, thank you very much for your support and for speaking today. Our next speaker is Cecile Renaud. Cecile founded Seraphim in 2002 after working in international marketing and advertising, and was inspired to launch her own company by several pregnant friends who requested tailored clothing during their pregnancies. She then guided Seraphim's development into the leading international maternity fashion label. The label received worldwide attention as people like Kate Middleton, the Duchess of Cambridge. She was pictured wearing Cecile's designer maternity clothing throughout all of her pregnancies, so not just one, but all of them. So during the company's rapid expansion, Cecile was involved in 2 private equity deals. The first one was with Bridgepoint, and the second one was with Mayfair Equity Partners. So Cecile, Daniel Sasaki and I used to work together at LDC, and then he went on to start Mayfair Equity Partners. Cecile then exited from Seraphim in 2020, so very, very recently, at an estimated value of over £50 million. Since exiting, Cecile spends her time supporting other female entrepreneurs, and she's here to support us today. So thank you for doing that, Cecile, and serves on the board of the Sherry Blair Foundation for Women. And I see a lot when you're speaking, a lot of different things, Cecile. So thank you for the support that you're giving to entrepreneurship generally. Our final speaker, and not last but not least in any way, Tim, is my good friend Tim. And Tim, his full name is Tim Weller. Hopefully you've all come across Incisive Media. He founded Incisive Media in 1994. It feels like yesterday, but it was a long, long time ago. And he successfully floated it on the main market of the London Stock Exchange in 2000. I'm just going to share something with you. I had the privilege of going to his house once, and I saw on in his lounge Entrepreneur of the Year with EY, and he's still very proud of that. So that just goes to show how much how important we are to the world and to the economy, and also celebrating those successes. It made me realize, Tim, that what I'm doing is important, what E2E is doing important, because we're celebrating entrepreneurship. So I will never forget that image of the Entrepreneur of Year in your lounge frame. So in 2007, he completed the $630 million acquisition of American Law Media, creating a group with an enterprise value of over $1 billion. And in March this year, that's over $1 billion. In March this year, Tim led the successful $1.4 billion. I'm only talking in billions with Tim now. $1.4 billion IPO of Trustpilot, the leading provider of trusted company reviews, where hopefully you've all come across it, and he remains the chairman of Trustpilot. He has an extensive experience in chairing public and private equity venture-backed businesses in the technology and media sector. He's currently chairman of Resi. Hopefully you've all used it. It's the large online residential architecture in the UK for residential, I guess, bookings. He's also a non-exec chairman of SohoNet, the leading technology provider to the media and entertainment sectors. He's chairman of Pixomondo, an Oscar-winning VFX company, and of Mayfair Portfolio Company. I've just mentioned a few there. What I'd also just like to tell you something which I've taken from him about 3 years ago, and I haven't yet achieved it yet, is to become a twat. Do quote me on this, which is basically to work Tuesdays, Wednesdays, and Thursdays. So if you've done it, you've made it. Hopefully we can all aim to be a twat. So I'll never forget that as well.
I'm definitely one of those. Definitely one of those.
Okay, so I'd like to say thank you to all of them, and I'm going to kick off. John, if that's all right, I'll kick off with a few questions, and then John will join me with his commentary and his questions as well. And what we'll do is just please keep raising your hand. We want to make it interactive. So if you've got a question, raise your hands or just speak loudly and interrupt us. So we'll make it like normal life, if we may. So I'm going to kick off with Robert. Robert, you left Four Seasons Healthcare in early 2000. You made a financial exit from the company in 2004. Question really here is, why did you decide to leave the business in the first place? And what were the key factors in that decision? And why did you exit in 2004?
Great subject for a book, but I'll try and be brief. Well, I got into the care home sector by accident because I bought a hotel and was planning a closed hotel, and I was planning to convert it to flats and a restaurant and function room, and there was development grants available at the time, but between buying it and going for planning permission, the development grants disappeared. So I had to find something else to do with the building. And I came across care home use as completely accidental. And that was in back end of 87, beginning of 88. And that was the beginning of Four Seasons. I opened my first care home in May 89. Probably, I got into it by accident to get out of being stuck with this dead weight building. A lot of capital invested in that. And so really from about the first year, I thought, right, I'll open it as a care home, I'll fill it up, and then I'll sell it. So probably I tried from about 1990, the middle of 1990, I was looking for an exit, but I kept on growing the business, always keeping an eye out for the exit. And by the time I got to 1997, I had 7 care homes, 3 further sites to develop, but all in a close area in Scotland, where I lived in Fife, dealt with 1 council, 1 health board. And it was Sir John Harvey-Jones, if the older members on the call remember Sir John Harvey-Jones, who was quite a character. And I worked with him on Macmillan appeals. And he told me that too many people were like me in a regional comfort zone. And so he berated me for being in a regional comfort zone. And so from 97 to 99, I went UK wide, and I took Four Seasons from 7 homes in Fife to 40 homes UK wide. And then I was looking for well, in fact, initially going from 7, my plan was to go to 20, which became 30, which became 40, because every time I got to my goal, the kind of market of the size that you could exit at it moved. So the finishing line kept on moving. And by the time I got to 40, things were, I was desperately keen to get out. And I approached a company called Crestacare that was on AIM, and they, about would they buy Four Seasons Healthcare? And they said, no, but why don't you buy us and do a public to private? They had 61 homes and their share price was languishing below and a sort of unloved area on AIM. And so that was something which we then went on the hunt for private equity to back us to take Crestacare. But again, it was purely, well, we didn't get an exit at 20, we didn't get an exit at 30. Here we are at 40, and we're having to go to 101 to get an exit. But you have to do what you have to do. But no, we were looking for an exit from the very beginning.
Robert, thank you. In terms of like determining the company valuation, how did that happen? How did you come up with the valuation? Because obviously you went through a series of thinking here.
Yeah, I mean, one of the things that's very difficult when you're doing that is doing an exit is you're doing a number of different jobs at the same time. You're running a business with 40 care homes UK wide, but you're also trying to organize a takeover public to private of a 61-bed care home business. And the key thing you need to do is, and certainly we got it slightly wrong, is you have to look after the day job while you're looking at the big picture. And we certainly had to have our valuation of Four Seasons cut and shaved at the final hurdle, if you like, because we've been we had taken our eye off the ball of the existing Four Seasons business while we were working on the public to private deal and creating the bigger Four Seasons with 101 care homes and 6,500 staff UK wide. So definitely it did cost us by taking our eye off the ball. So focusing on the day job is certainly something, and also doing a stage exit. I mean, I know interest rates are very low at the moment, but the majority of my exit in 2004 that was organized in the autumn of '99 when we did the deal with Alchemy. The loan notes, although they ranked ahead of Alchemy's loan notes, they were actually unsecured, but they ranked ahead of Alchemy's loan notes, so they were pretty secure. But they accrued interest at 12% per annum, which was very good deal, and that's why I exited on a stage exit and exited finally financially from Four Seasons in 2004 when Alchemy sold Allianz. Well, they sold Four Seasons to Allianz for 775 million. I mean, the enterprise value of our deal was 127 million. And okay, Alchemy put more money in the interim to do acquisitions, but Alchemy still today tell me that that's the best deal that they've ever done as far as returns, and they got over 4 times their original investment back over just over 4 years, nearly 5 years, and that's something that I'm very proud of as well.
Well, they're a big deal doer, Robert, so you should be hugely proud because they're very active in the market. I was at my my brother's daughter's party on Sunday, and there was a company that raised 100 million. It's called DNA Payments. Again, Alchemy was the investor in that. So very interesting to hear that. John, do you want to come in with any of your comments here?
Sure. Robert introduced quite a few terms there, which are used quite often within private equity. And for those on the call that have maybe never encountered private equity or doing any kind of deal, I'm going to just try and break it down of, the way people look to value businesses. I could spend the whole day on this, but I'll try to break it down.
I had a full head of hair before I engaged with private equity. And so just a warning to those on the call, this is what happens when you engage with private equity.
I think at least for today, I'll focus around the private markets, because the majority of people probably on this call will go on a journey that will result in either a trade sale or a private equity type transaction. We can talk about public markets, and I might touch on it at the end. But in very simple terms, if a private equity firm is looking to make a return, and one way or another, as Robert mentioned, Alchemy made 4 times money on the transaction that they did with Robert. In summary, private equity look to make 2.5 to 3 times their money. Quite simply, put money in 4 or 5 years' time, I want to make 3 times that. So your advisor, you're working with someone like finnCap, we sit there with you and interrogate the business plan to say, well, this is where you are today. If this is the value, if this is where you're going to be in 3 years or 4 years time, assuming we exit on the same multiple, i.e. simple maths, if you're making 10 million profit today and someone buys you for 10 times that, someone's paying 100 million for that, is, well, someone down the line wants to make 300 million. So it is, how do you go on a journey of getting to 30 million of profit now in 4 or 5 years time? I'm trying to keep things quite simple now. So partly the valuation today is partly based on how that private equity firm is going to make their 3 times money in 4 or 5 years time, and we help interrogate that. I won't go into leverage buyouts, because once you start including things like debt, or as Robert just mentioned, low notes, which is a way of private equity getting enhanced returns, it just kind of muddies the waters a bit, and you just need a financial advisor to talk you through that in detail. Touching on trade slightly, quite often entrepreneurs say to me, John, it's just that business just being bought for a crazy price. How do they do it? Can I achieve the same? In truth, the answer is always, it depends. It depends. It depends how strategic that business is to the acquirer. I'll give you a case in point. A business we sold last year called Case Lines. It was legal technology. It was only making 3 million turnover. We were due to sell it this year. We had been engaged with them, but there we picked up the phone to the owner in lockdown and said, it's time to go right now. Your technology is applicable to the market right now when courts aren't operating. There we got Thomson Reuters, and this is the art of negotiation. This is where they initially priced it at 20 million and they ended up paying 38 million for the business. Why did they pay 38 million? I love to sit there and say, this is what my team did. We got them to that price. But in truth, you bring in strategic different buyers and go through a negotiation process. So as I said, Shalini, this is a subject matter I could talk about for a day in different parts, but there's just a quick summary of the way people look at buying businesses.
Thank you, John. I really appreciate that. And so can I just ask you that, do you think part of it is our skill in marketing? Is it about marketing?
Which part in terms of selling? They're
getting the price for that business rather than 20 million to getting it to 38 million. Obviously, they had a great technology and timing was important.
Other people might want to comment here. Partly, it's down to the experience of that financial advisor. Okay, it's one, what is the market clearing price? And that's, you can use science to do that. You can look at past transactions in the market and say, this is the multiple they were bought at. You can look at public companies that's similar to your own to call it a market clearing price. But after that, Shalini, it comes down to the transaction you're in and the moment you're in. And this is where you need a very experienced advisor who can know how to best push that price to the maximum. You always want to feel like you're leaving the buyer something on the table, some crumbs, but your job as an advisor is to keep pushing and pushing and pushing the price up. But only if you are in this industry, I would say, do you therefore know how to do that?
Thank you, John. I'm going to bring Robert. I'm going to come back to you, and I'm going to bring Seraphim in, Cecile in from Seraphim, if I may, right now. Cecile, during the development of Seraphim, it appears that you reached several points where it was a question of raise or exit. And what was the decision-making process that you went through? Because initially you had the support of Bridgepoint, and later you chose Mayfair Equity Partners. So how did you decide to work with either of them or both of them? And what were the decisions that you made to pick those two partners?
So basically, just to give an understanding of how I grew the business, I did it in a relatively what would be called old-fashioned way, that I raised a very small amount of money at the onset of the business and then just grew on our own cash flow and our own profitability. So I was in a position where retain the majority of the equity. And at that point, I was really looking for two things. First, to have a material gain and a sort of life-changing amount of money. So, for my own life. So I really saw the first exit working with Bridgepoint as, that opportunity, basically, as well as an opportunity to de-risk myself a little bit, because I had put 100% of my life in this company. I had the vast majority of the equity, and I felt that you never know what happens in the future. It's better to diversify a little bit. So when I went in the process, I selected Bridgepoint. We obviously did, have a number of private equity interested, but at the time I decided to go with them because they had such an international outlook. And Seraphine is a very international brand, and most of its growth was coming from Europe and the US. So I really wanted a partner that could support us, in that strategy. And they came in, and I sold them a majority shareholder. So I went from being, a sole founder, having practically all the equity, to suddenly not having the majority in my own business, which was a little bit scary. But I have to say that I didn't regret it at all, because we worked extremely well together. For me, it was a huge relief to have someone else on the board. I think entrepreneurship can be a little bit lonely. So all of a sudden having a team that was there, and I some people see private equity sometimes as you have to report to them and they tell you off if you don't reach your milestone. But actually, I lived that very differently. I really felt like they were there to support me in reaching the goals. And, I really enjoyed that partnership a lot. So then, as it's been explained, what private equity want to do is they want to, exit their investment within a window of 3 or 4 years. So when Bridgepoint came on board, we had jointly agreed that our goal would be to sell again 3 or 4 years later, which is what happened with the deal of Mayfair. We were obviously kind of initially slightly derailed by the pandemic, which hit in March, which was the time when we were about to go to market. So we decided to pull out and wait. But fortunately, as we are an e-com company, we were able to continue the growth trajectory and meet our targets. So when came September of last year, we decided there is market momentum. There was a lot of pickup of transaction because the market had been very quiet for 6 months. So we decided to go ahead, and this time we picked Mayfair Private Equity, and there the decision was really motivated on the fact that they are very e-commerce driven, and that's their speciality. So it felt like it would be the right strategic partnership.
Thank you very much. Very, very clear reasons in terms of your decision-making process. And I think it's great to hear the positive side about how supportive Bridgepoint were in terms of working with you and putting in, I guess, a timeline horizon for your next exit. Cecile, thank you for sharing that with us. I'm going to move on to Tim, if I may. Tim, 2007, taking you back quite a few years, you completed the $630 million acquisition of American Law Media, creating a group with an enterprise value of over $1 billion. What was the most challenging aspect of that deal?
I suppose what then followed. So, okay. Not necessarily the deal. Look, I mean, this is now, and that was then. We were a highly levered buyout. So when we took the business private back in 2006, there was only 60 million of the ticket written in equity, but there was 240 million written in debt. So we had 9 times lever on our balance sheet, which was at the time absolutely fine because we generated so much cash. And I was as greedy as the next person. I saw the returns that I could make through, good quality cash generation, and then growing the business and evolving the business. So look, actually finding capital back in August 2007, believe it or not, wasn't difficult. We had a 550 million check written to us by RBS. That debt was not syndicated, and the rest was equity. So actually a relatively small portion of equity was delivered by Apex. And for me, the lesson learned, we didn't see the financial crisis coming. Having said that, as a financial media business, we were reporting on it months later because we owned assets like Risk. So we actually saw what was happening in the collateralized debt market. So look, the lesson learned post that deal, and look, John's talked about valuation metrics. The valuation metrics on that deal, it was a competitive auction. We really wanted the business. We'd approached them before the auction, and we felt with the hard and soft synergies we could drive into that business, it would be a great value to us. And the sadness of it was that we integrated that business very quickly into our group. We rebranded some of their assets, and business was really flying. And then the financial crisis hit. So what I will tell everyone on this call is beware of debt, the amount of debt you have on your balance sheet, because the next 4 years of my journey were fucking difficult. So we spent quite a lot of time negotiating. Are there any banks on this call? We spent quite a lot of time negotiating with 22 banks in the syndicate, okay? And most of those banks are complete numbnuts. They had absolutely no idea operationally how to manage a business. And it was tough. It was a very tough period in my professional career. Having said that, we came out of it. We made money. And actually, sort of back in 2017, we went through a very different program of value creation. So debt and leverage, over leverage, can wipe out equity pretty quickly. So beware.
Yeah, and if I can add to that, actually, in the public markets, they don't love debt as much as they do in the private equity market. So you tend to find in the public market, anything beyond 2 times leverage, they're beginning to get a bit of a nosebleed at the moment. Now, in the private markets, I've seen it all. In the downturn, it dropped right down to kind of 2 times leverage. And then you start, and I saw that from 2008 onwards, and it starts creeping back up. Now, for a lot of tech companies, and as you said, Tim, where there's good, solid cash flows coming through, you're beginning to see leverage at 5-6 times. I won't talk about hybrid debt funds either, which is even higher. Let's call it, 5 to 6 times leverage. The only thing for an entrepreneur to be really careful of is it sounds good on paper that you're getting a high valuation, but where do you sit as an entrepreneur in that capital structure? Because a private equity firm, generally speaking, will look out to look after themselves. You just need to make sure that you as an entrepreneur are being looked after. I'm going to use the Latin term that's used quite often in deals, which is pari passu. You just need to make sure you're being treated the same as the private equity firm and not looking at the day one ticket alone.
Unless you take it all off the table.
Unless you take it all off the table, yeah.
Okay, thank you, John. But Tim, thank you for the advice to both of you. And Tim, when I was talking to Dana yesterday, I hadn't realised that you'd taken so much leverage. It takes someone with a lot of, I guess,
kahunas.
I can't say it, we're live, otherwise I'd say it to you privately. Anyway, so
listen, you should look at what I've done and done the opposite. Okay. We floated the company because the cost of capital back then, equity was the most efficient form of capital for us to use to buy and build. We floated the business in 2000. We were very successful. We took the business private because the cost of capital switched. As John has said, we couldn't flex our balance sheet. We were highly cash generative. And my view is at 300 million, we were too small to be on the main market. So our aspiration was to grow the business and scale beyond $1 billion so we could come back into the FTSE 250 and you get the liquidity that you need to be able to grow the company. So look, yeah, I'm not too ashamed of it because, to be completely frank, selling shares as a public company director is also quite tricky. So what we did as directors was sell our shares at a stonking premium by Apax, and we then only had to roll a percentage of that into the new structure. Plus we then got sweet equity underneath, but recognizing that sweet equity sat at the bottom of the waterfall and where the value came. Anyway, sorry, Shalini.
No, thank you. That's very helpful. What I want to get into is, we're talking about having the kahunas, is how do you get that mindset? So for example, with E2E, we raised capital last year we gave away equity. I decided not to go for a loan. I decided to go for equity. I don't have those kahunas like you do to take so much risk. You have to be very, very confident around the way, and I think the discussion around the cost of capital is a very, very important one, which hopefully there'll be some questions on.
But Shalini, I wouldn't take a lesson learned. I'm a huge believer in cycles and moments in time. Okay. Yeah. And there is no question at the moment, we are in a moment in time. Corporate balance sheets have never been so strong. Okay. You've got a huge wave of capital through quantitative easing that has been driven into the market, particularly in ESG funds. And also into private equity. So there has never been more capital at work hunting good quality assets. So if you're a business that actually is either looking to raise capital or exit, today is your moment. Okay. However, be aware that if you take that day, you seize the day, equity is a key driver of value, of course. Debt could be a driver of value, but also is totally and utterly destructive. So whilst I have massive kahunas, yes, I'm massively, massively fucked up, okay? Because equity went to zero and I had to reface and rebuild. And luckily I did, because we all made, and we actually sold to Alchemy, and we didn't quite make 4 times the money, but we did 2.7 times our money, but in less than 2.5 years. So in terms of IIRs, I'd say we're up there with Robert. But it took us time to reface for us to then make the same return again for our investors. And ironically, our banks who stayed with us through that period made 1.5 times their money. So the banks that sold out to the CLOs and to Alchemy could have made a significant return, but they didn't, because it was all about timing. Sorry.
Tim, thank you very much. I'm going to come on to Robert. Robert, how did you decide which corporate finance partner to go with, and who, in terms of the acquirers for exiting, what was your thinking around how to pick firstly your corporate finance partner?
I mean, as Tim said, I mean, timing is everything, and as Tim said too, these definitely go in cycles, and it's being in the right place at the right time. But equally, my father used to say that it's not the percentage of a company that you own that's important, it's the value of that percentage. And by involving private equity, if you catch the waves better, then it's worth doing it. But from our point of view, we got to the altar with Credit Suisse, but because the enterprise value at the time was because it was over 100 million, the decision had to go to New York. So we had to fly out to New York and present there, and New York said no, and so we had agreed a 50% premium to the share price for Crestacare, taking it public to private, and I think it was something like it was 26 pence a share, and we'd agreed 40 pence a share, or 39 or 40 pence a share. Unfortunately, in that time, and this is why we're also trying to keep the day job going and keep adding to the existing Four Seasons business at the time, what we did was we had to go back to the beginning after Credit Suisse said no. And that's when we came across, through mutual contacts, came across Alchemy. And Alchemy were very good and got up to the altar very quickly. Unfortunately, the share price of Crestacare had stayed in the doldrums around the 25 to 27 pence range. So we still got the deal done. We had to go back to them and ask them to give us an extended period. And they were happy to do that. But one of the other things which is key, I think, for Cavendish, who I have dealt with Cavendish part of finnCap before, is early planning is key as well. And getting early help and advice from Cavendish, for example, is key. It's never too early to have a conversation with Cavendish and similar companies. They can help you. They can look at your business and say, well, the multiple in this part of the business is fine, but the real high multiple is on this part of the business. But you need to get that part of the business with a high multiple potential to be a bigger part of the business. And that might take 2 or 3 years. So you need to find a partner in the corporate finance side that's going to work with you and help you on that journey. And but we ended up with Alchemy at a very short notice, and it was certainly something that was successful. And I've done deals with Alchemy since, smaller deals, but I've done deals with Alchemy since. And also on the loan note side, we were able, we did get a bit of a bit of a haircut in the value of Four Seasons at the last minute, because the performance of the existing business, while our eyes had been off the ball, had dropped. But they did give us loan notes that ranked ahead of, not level with Alchemy, but ahead of their loan notes. So that was a bit of a balancing act. And that was something which was all part of tough negotiations, as John said, in the heat of the battle. But having the right advisor on your side is absolutely key.
Okay, and just a quick one. Thank you for the important tip there on starting early. John, when would you say is the right time? Is it a year before we decide to sell or exit, or is it 2 years in advance? When's the right time to plan an exit?
When companies come to us and say, I want to sell my business and I'd like to be in the market in 2 months' time, I kind of sigh, because you do need the time. I could sit here and go, this great, bring it in and prepare the marketing materials and go out to market. To do our job properly, we do need time. And as Robert just said, we can add so much value.
Yeah.
I'd rather a company 18 months before. I'd rather see, because that's when you're beginning to get to know a business, beginning to get under the skin and beginning to provide advice. And I'm going to provide you with a story only because as I'm on this call, I've had a text through from an ex-client of mine. We sold the business probably 5 years ago now. And he just invited me to see England tonight at Wembley. So I think I'll accept that one. Now, when he first came to us, he said he wanted 12 million for the business. And we prepared the company. But as we got to know the business, we felt that there was a lot more in the tank, and there were some efficiencies in his business that he could put in place. And that's where I said to him, stop, we're not going to market you right now. We will put these things in place, and let's revisit where we are in a year's time. And we worked with him for a year. Now that business, at the beginning, yes, it was probably worth 12 million, but it went on to sell to one private equity firm for 38 million, where he sold a minority stake. And then that business has been flipped on again 2 years later to Inflection Private Equity now at 100 million valuation. And he still owns 35% of that business. Now for him, he will say, the best thing I ever did was speak to Cavendish early. And it was the fact that you didn't try to put me in the market straight away. You offered me proper, good, solid strategic advice. And when we were ready, that's when we went to market. So there are many different types of advisors out there, Shalini, many different types of advisors. But we've been around for 33 years now. We've got a very strong reputation. And now again, within finnCap Group, in terms of the wraparound service we can provide, an e-commerce business we're selling right now, just to give you an idea between private and public, is much bigger than most of the companies probably on this call today. But that's a fast-growing e-commerce business, excellent management team, would happily be suited with private equity or the public markets. And we soft marketed both market. We started speaking to private equity and to institutions. The private equity market, although there's tons of money out there, came up with a valuation between 150 to 175, soft marketing. The public markets came up with a value between 225 and 275. And there's not.
We dual tracked Trustpilot too.
There we go.
And there is a dislocation at the moment between valuations and private to public because of the wall of capital.
And both ways. Sometimes it's private equity that works better than the public market. So within our group, and they're both very different skill sets. So I can't sit here and say I'm an expert in the public markets, but we have 60 people who are experts in the public market. But the fact is, within that one group, we're able to always, as I said at the outset, provide the right advice to the client and what they actually want to achieve.
Okay. But is there a general rule of thumb? I'm going to ask the audience. I know people want to ask questions. We're going to open it up in 10 minutes. So please be ready. Raise your hand. Put it in the Q&A. I've had a few messages through. But is it generally that the public markets tend to get you a better valuation than private?
No.
It really does depend from sector to sector. It really does. There are some cases, again, where you naturally say, go to the public markets, you'll get your equity way on a quite a cheap basis versus the private equity markets, but it's vice versa. Key thing again, as Tim and Robert probably knows, is that you do need to work with an organization who can look at whole of market. I haven't even spoken about family offices. The other big change we're beginning to see at the moment is how family offices are now going direct. Before, they would actually be an LP, they would put their money with a private equity firm and say, invest on my behalf. They're still doing that. At the same time, they want to make direct investments too. So in that case, we managed to poach someone from Rothschilds last year who has connections across Europe in family offices, which are notoriously hard to break into, notoriously hard. So this is one, again, where, as a group, we are trying to provide full market coverage, whatever that may be.
And they take a longer term view on family offices, generally take a longer term view as well compared to private equity, which in some sectors and some opportunities is a huge plus.
Mm-hmm. Robert, thank you for that. And Cecile, you mentioned when you were talking earlier about your experience with Bridgepoint and private equity. I guess we just want to delve a little bit more into the way of life in your thinking and your mindset. How was it like to work quite closely with private equity for a long period of time and sort of give up your majority stake to a minority stake? How did you feel, and what the emotional thinking around it? It'd be nice just to chat a little bit about that.
Yeah, I think for me, emotionally it worked really well because I was prepared. This is really what I wanted. So, that deal was signed. For me, it was an achievement. And where they really helped me was to build that 3 to 5 year plan with a lot of accuracy and to a level where we felt we can genuinely deliver that growth plan. Mm-hmm. So I found that really helpful because as an entrepreneur, when you build your 3-5 years vision, sometimes you do question your own, what you're putting on the table. So having a sounding board that kind of challenges you, supports you, was really extremely helpful. During that time, I also stepped down as a CEO. So I recruited a person first as a COO and managed that transition, because this is one part that is really important to plan. As a founder, if you want to gradually exit, you need to start showing that you are not the centerpiece of the organization. Otherwise, people are not going to let you, diminish your equity. And that transition is quite tricky to manage, but I have to say that in my case, it went really well. And again, I felt like the support of Bridgepoint in that recruitment and in allowing the new person to step up gradually was really helpful. So overall, for me, it's been an extremely positive journey in every respect. And we set this goal of selling on the business after 3 years, and it didn't feel that it was rushed. It didn't feel like I was over pressurized, which is also sometimes, I think, a concern for entrepreneur, to think I'm going to have somebody who's going to be like constantly pushing me harder. So I feel like they really showed a great understanding of the entrepreneur mindset, of our psyche. And for me, that was actually more important, because when it comes to running the business, they're not operational people. So whilst they can give some advice of things that they've seen in different businesses and some classic pitfalls, it remains quite textbook sort of things that you're learning, but their appreciation of what you're delivering as an entrepreneur and them being very supportive is I think really important in that journey.
Can I add two things to that, having had direct private equity experience? Look, I think be very wary of personal chemistry. So I think personal chemistry is fundamentally key. So don't necessarily go for the highest price. Go for the team, as Cecile said, go for the team where you can clearly have a combined vision together, and there is personal chemistry, because when they become the majority owner of the business, it is their business.
Yeah.
So, at the end of the day, they will dictate the timing on an exit. They control it in that sense. You operate it for them. So I think, getting on with your buyer is fundamentally important. And having the same sort of cultural mindset is also fundamentally important.
Thank you very, very. I said at the beginning we wanted some of the real secrets, and I think that's definitely something that we need to consider. But Tim, can I ask you, how do you know you've got the right chemistry? How long do you date for?
Oh shit, Shalini, that's a tough one. I'm not that fussy. Having said that, I've been mind-numbingly answered. No, I've been married for 33 years, if that one helps. Listen, my job as a chairman invariably is to get entrepreneurs to trust their instinct, okay? You know when you know, Shalini, don't you? You know when you know. And I knew when I met my wife 33 years ago that she was the right one. And by God, have I been lucky. So just if your instinct, your gut is telling you, what a wanker, all right, don't partner with them.
Okay.
Because honestly, you've got to make sure your instinct sort of drives some of that decision making. And there are some wankers out there, I'm sorry.
Yeah. There certainly are. There certainly are. Now, I'd like to consider as our group or
there you are.
Obviously.
Using the same, analogy that we're talking about. We're like the Tinder algorithm then, okay, where we provide the matching. So we know who the market is, but every company requires a different type of investor depending on who you are. Now, God knows there are, 300, 400 on the private equity side, mid-market investors out there right now. And it depends on the home you're looking for. And we try to make sure we filter that right down so that people that you're seeing, let's say the 10 private equity houses you're seeing, we feel like they're going to be the fit for you. But then it's down to, as you just said, Tim, it's down to you and feel that chemistry. And you're absolutely right. It's your gut. What I've always said, gut instinct that tells you.
Trust your gut.
Trust your gut, 100%.
Yeah, absolutely. Trust your gut, and self-belief is entrepreneurs are, as Cecile said, it's a very lonely. In a lot of occasions, it's a very lonely place to be an entrepreneur, and certainly also, as Cecile said, having a private equity partner helping you, there has to be huge trust between both parties, even if they're the majority. They're trusting you to run their business. As Tim said, it's their business, and that's quite a change, as Cecile said, and it's not necessarily for everyone, and it certainly I found it tough for the short period that I did it with them, but the whole point was to engineer. It was a means to engineer an exit, but I kept my investment in, and I'm very thankful that I did. But timing is everything as well, and I think the introduction of the family offices into the scenario of public or private is a really interesting one that I'm certainly getting approaches on the care home sector. The public sector is not really, or the public markets is not something for the care home sector. It's very much private equity or family offices are the two options at the moment.
And dare I say it, it's not always around the highest price. If you're selling 100% of your business, clearly go for the highest price. But if you're on a growth journey, we're talking about this right now, on a growth journey of trying to find the right private equity firm, it's not necessarily the highest price. Sometimes
100%. 100% agree.
Off the call, you actually said, or what your father said to you, it's about the piece of the pie you have and the value of that piece. There are
that you build together. Yeah, I have seen it where it didn't work, and it completely collapsed. In a smaller business that I invested some of the proceeds from Four Seasons in, and private equity and the management fell out, and it just completely collapsed. Private equity the management went off and started up again in competition, and private equity were left holding, in essence, a valueless shell. And that was an example of how it didn't. I mean, it is, but that's what you guys do, and do well, I would have to say, is say, well, such and such are interested in the sector, but I don't see them as a good match for Robert, a good, personality match, or I see personality clash there. And so that's a huge part of it's not about just getting it, unless it's 100% exit, as you said.
Yeah. Thank you. Can I just ask Cecile, do you have any, giving up your baby, 100% exit now, am I right in saying that you've completely exited from Seraphim? Do you have any regrets?
I would say no, because I was really prepared for that. But of course, it is an emotional journey. I can't deny that all of a sudden, you're really completely out. But I think it really depends on your mindset. For me, I think you have two options. Either you see your business that you're going to pass it on to next generation, and you want it to, keep on for decades and decades. In my case, I have two sons, and I didn't see them interested in a fashion business. So I really felt like this is the right time for me. It also reached a size where it was a different kind of business, that it was becoming more a big business. And I think as a founder, my heart is in things where it is kind of smaller, less corporate, and very creative. And it does change the pace as your business grows. So I would say no, I don't have regrets.
Okay, great. Thank you very much. Really delighted to hear that, and wishing you the best now moving forward with all the smaller business that you're supporting, Cecile. So I'm going to open up, because I know Ben Mekki has a question, and Chandani Vora, who's also one of our investors, and I have to congratulate her too, because she was alongside Tim Weller cycling for the British Asian Trust. So if you haven't
put amazing
charities, I think they can put the link. It's not rude to put the link in the chat function on the below bit, Tim and Chandani, if you wanted to, because it's still raising money for very good causes in COVID-affected businesses, COVID-affected individuals all over India. So please do put your link in if you wanted to. I'll start with Ben. Ben, can I say hi? Great to see you. And I'm going to encourage, and we've got a lot of friends here. It's nice to see Kevin Rishas. It's nice to see Lawson, Barry Leahy, lots of our members today. So please do feel free to, Rupert, hi, good to see you as well. So good to see so many of our members online. So please feel free to make a comment, ask a question, chat, talk about your companies if you've gone through similar experiences. We want to make it interactive for the next 25 minutes or so. So Ben, hi.
Hi, hello everybody. I'd like to please ask the panel how important they think it is to have the right skills in the finance team.
Can I come in?
Yes, Tim, please do.
I mean, look, it's an obvious question. Absolutely fundamental and important. And I was blessed. I mean, he's still working with me, actually, have to say, jointly owns Incisive, having the most phenomenal finance director. And we hired very early and sort of hired ahead, if that makes sense, when we were looking to IPO Incisive. So whether it's whatever exit you're working on, it's fundamentally important. And again, we did the same with Trustpilot. We doubled down on that team. It's the key partnership that you will have going out and presenting in the market, whether it's private or public. Absolutely essential. John?
I completely concur with Tim. It's fundamental. The likelihood of getting a transaction done, especially if you're looking at private equity, it's slim if you don't have a solid finance function. Now, there are many, and sometimes with the clients that we advise, sometimes we have to be very tough with them. They think they have the right finance function.
Yeah.
Tell them you don't have an FD, you have a controller, which is very, very different. You know, what you put a management team through when you run through a process, it's tough, but it's especially tough on that finance function. So you need to make sure you have the right team in place. And quite often what we do is to make sure that you put interims in place if needed. Where there are many companies out there, and I know Ben runs a business like this, there are many companies out there who put the right skill set in place to facilitate a transaction getting done. As a corporate finance house, there's so much we can do. Yes, of course, we have lots of ACA qualified accountants in the building, but when you are in front of the investor or the trade acquirer, it will be ultimately the CEO and the finance director talking about that business. So again, goes back to the planning, Robert, Tim. If we have time to say, this is what you need, put them in place, then you have a better chance of getting a better valuation, probably a better structure by planning early.
Yeah, definitely. We had a deal with Renaissance Care when I went back into the care home business, having said that I would never go back. I wanted nothing to do with the care home sector at all ever again when I exited. But I missed the people and I missed property. Well, I could have, I suppose, gone into a different sector, but the care home sector is very people and property oriented. And those are the two things that I'm passionate about. But we nearly did a deal with private equity with Renaissance Care, and it was due to complete in April 2020. But obviously with COVID, that was put on hold. And in the end, we both agreed to walk away from it and cover our own costs. But they actually said to me, I hope you know, we've been through a pretty much a 12-month process to get to the point where we were a month away from completing. They said, I hope you realize and appreciate how good your finance director is. And that was nice to hear, because I have to say my finance director and I don't always agree, but then that's a good thing, I think, as well. He keeps my natural enthusiasm under reasonable control, which is also essential for an entrepreneur. I mean, another one of my father's sayings was, as an entrepreneur, never be afraid to surround yourself with people cleverer than you. And there are a lot of entrepreneurs that don't like that. They like to surround themselves with people that are not as... I love surrounding myself and being pushed by people that I bring on board that are cleverer than me. I find I perform better, it improves me. And I love that challenge and that push that I have to be on top of my game. Even though I own the vast majority of the company, I have to be really on top of my game because of the smart people I've brought on board. But yeah, finance is absolutely key.
Thank you very much. Very, very helpful advice there. Ben, you've kindly said that you've got I think a document around the things to look for in an FD. Would you be kind enough to share that with us?
Yeah, sure. There's a white paper called the 5D FD, which explores the 5 skill dimensions of a contemporary finance director, being scorer, custodian, business partner, catalyst, and strategist. So I'm very happy to share that if anybody's interested. It's a 30-page document that explores what great looks like in a contemporary finance director.
And I would love to see that. And I presume sense of humor is not in there in the list, is it?
Well, I think they would argue that to be a catalyst and a strategist and a business partner, empathy is required, if not humour.
I'd add analyst. Can I add analyst? If you're selling to private equity, you will have to have a KPI dashboard.
That comes within the custodians.
Yeah.
That comes within the custodian dimension.
Yeah. You have to know what the key drivers of value are, and that's fundamental.
Yeah, my finance director says I'm the glass half full, and he's the glass half empty. That's why it works, but that's what he says. So.
I've heard someone, I think it was my father in this case, that said to me that the best decision, if you want a corporate valuation, you need to look, smell and feel and behave like a corporate. And in order to do that, you need to make the right decisions. And the best decisions come through an alignment of an entrepreneurial, intuitive entrepreneur, but with decisions corroborated through data by the right finance director.
Yeah.
Thank you very much. That's, again, Ben, anything more? Otherwise, I'm going to go on to Chandani, if I may.
Sure, just send me your email address, Shalini, and I'll email it to you, and I've put a link in the script.
Thank you so much. It's very kind. I'll share it when we do the follow-up email tomorrow. We'll send it across for everyone. Thanks, Ben. So, Chandani, great to see you, and huge congratulations again on the cycle you did with Tim.
Thank you. It was an experience, and as Tim will always start his speech, I'm surprised he didn't say it's a race. But anyway, it's good to hear from Cecile, John, and Ben, and Tim, of course, of your vast experience of how you've managed your businesses. Your businesses are in a very large scale compared to and relevant to our business. This question is probably more for John, where our industry is a construction industry, and there aren't that many benchmark values out there to create an EV. How do you think finnCap can help that? And the second question I had was, you've spoken very widely about private equity. The ethos of private equities is probably not as much as an entrepreneurial's emotional attachment to a business. What is the alternate options available if businesses that are mature in the growth stage, looking potentially on these topics that you've all discussed? So I think it's probably a John question, being the technical speaker on today's panel.
Is your business actual construction, as in house building construction?
We're main contractors in high-end residentials, a lot of the five-star luxury hotels that you've probably all dined in. So we are main contractors.
Yeah, we've actually worked with companies like yours before, actually, and if you go back pre the last recession, we did sell a couple of businesses like yours. But you're right in terms of trying to get that value. The problem is, and it's no different in a way to our own business as in M&A, it's very project based. Okay, so it depends what you're trying to do. It is, and again, I will look at your business, and my partner Andrew Jeffs, this is an area he covers, but in terms of, I'm just going to compare it slightly to consultancy, which is project based, and assets I've sold in that space before. What they're really looking for is, one, your track record of who you actually work for and longevity of those relationships. Two, what does your pipeline look like overall? Again, three, again, I've heard this within the building. You're a main contractor, but how much of it is your own guys? How much of it is subbing out to other people? And then I heard this from Tim earlier. It depends what you want to do. It's about timing and the cycle. So if you are looking to exit completely, and I don't know how big you are, arguably right now with the swathes of cash out there, there's probably not a bad timing. But it sounds like maybe you're looking to raise capital, raise some debt.
I think it's more of the topic that was started earlier on by one of the panelists was that you need to think about what is that plan for the next 5 years, and those dialogues. And I think it was you, John, that said that you need to understand as your business. We've got no plan to exit yet. We're very much involved in the business, but it's attending at seminars like this that E2E brilliantly put panelists together is to actually get an appreciation and understanding. And as Robert said, we need to speak to people that are cleverer than us.
Also, actually, one thing we do is where you start thinking about, I use the word precedent. Similar companies like yours, where have they gone on to? Who have they been sold to? And again, making sure if you are looking to exit, do you partly go on a journey to say, if I'm looking to exit in 5 years' time, let's just say, what direction does my business have to go to make sure I look attractive at the end of that period? But look, more than happy to take this chat offline.
Thank you very much. I'll make the introduction, John, and Chandani, thank you. Very, very useful question. Hopefully appropriate for many of the participants today. And it's good to see you, David. We've got David Ball. I'm just trying to make sure that everyone...
We used to work together years ago.
Oh, did you?
Yeah.
Okay.
He's
so,
bloody successful, he is, that David Ball.
Okay, well, he's joined us today, so I'm trying to bring everyone in, and we've got Leslie Morgan of Durban PLC. I've talked about Silas, Mitesh is also here, Charlotte, Hayley. I'm just going through the names so that you could all, if you wanted to put your cameras on, we want to make it as interactive. We've got about 15 minutes to go. I know there's a question from Demetrius Hastis. I'm going to bring him in just a minute. He's also one of our advisory board directors and an investor in E2E. But before that, I have the pleasure of bringing in my mother, Dame Khemka. And Mummy, it's good to see you. I didn't know you were joining today, so I'm really glad that you are. Do you want to... just need to unmute, that's it. Yeah.
Good morning, everyone, and thank you, Beta. I'm so proud. It's just amazing to see Shalini bringing in so many amazing entrepreneurs together on a regular basis. And do you know what? This is my opportunity to thank some of you. But today, it's Robert, Cecile, John, and Tim. Many congratulations on such a wonderful session. All of you been just amazing. The journey you have been through. My question is, entrepreneurs possess unique set of skills. Their characteristics are very different. You have mentioned quite a lot of things. Leadership, bringing in people together, perseverance, appetite to risk, and so on, so on. Do you think entrepreneurs are born entrepreneurs or are they made? Or both of both, or a combination of that? Because I have been all my life in education, and I have been a public servant all my life, and I have produced entrepreneurs in my family. So I'm just asking the question: are they born or are they made?
Okay, I'm going to ask each one of you, Robert, Cecile, John, and Tim, to answer your own thought on that one. So maybe, yeah. Robert, could I kick off with you?
Yeah, well, entrepreneurs are certainly wired differently. My wife's a corporate animal, lawyer, corporate animal, big company person, and she says, yeah, we're completely wired differently. I would also say, I think a lot of entrepreneurs are frankly unemployable. I think I'm probably unemployable, but maybe that's something that you need to be. You need to be always dealing with rejection a lot. You know, you hit a brick wall, you find a way through it, over it, under it, round it, and the self-belief that is required. I think probably acting is quite similar, being an actor as far as dealing with rejection. But we are wired differently. I'm really interested, I always have been interested in this, are they born or are they made? I think there's a bit of both. I still feel the jury's out on that, certainly from my point of view.
Thank you.
Thank you. Thanks. Cecile?
Sorry, I have to put on mute for a minute. Apologies.
No problem. We'll go to Tim. We'll come back to you.
Right. It's a great question. I'm adopted. So I found out that I was adopted literally from the day I was born. But what was extraordinary is that about 7 years ago, my mother, who actually unfortunately was forced to give up me when she was basically 15, her family were in the print business. So there's no rhyme or reason why I went into business media, nor any rhyme or reason, I suppose. One of my first big chairman jobs was chairing Europe's biggest print company. But there is some inherent link, I think, in the genetic code that says something about that. Having said that, my adopted parents were just brilliant, and my father was an entrepreneur.
Yeah.
The personal characteristics, I think, are. I'm sorry, I'm thick as thick as dog shit. Basically, I am really not that bright. I got a third-class honours degree in zoology. I even got caught cheating. I still managed to get my degree. So education, I'm afraid, Dame Khemka, is not probably something I can vouch for. Because I've always said creativity is great, but plagiarism is faster. So my mindset's always been, if you can do what others do better, you'll do well. And that's what we've achieved to do in life, set out to do in life, is to basically look at others do well and then just do it better with a relentless pursuit on quality and having fun. I just, frankly, I've never stopped having fun.
Tim, I would just like to say, Tim, that I'm also adopted. And in fact, during lockdown last year, I discovered 2 half brothers that I didn't know I had. Same father, different mothers. And one restores classic cars and one is an architect. But my adopted father was an entrepreneur. So, I mean, that's where I feel I got it from. I think it was inherent in me from an early age at school. Some of the activities I got up to at school, trying to buy things at one price and sell them for a profit within school grounds. I was up to that quite a lot at school and got into a lot of trouble for it as well on occasion. But it was my adopted father that I sort of took the lessons from and whatever. But it's interesting, through lockdown, I did meet 2 half brothers I didn't know existed, which is quite a journey that I've been on in the last 6 months. It's been quite fascinating.
One thing I would add is my professional education. My professional education was born out of this amazing company, VNU, which is now, we actually ended up buying, but it was now known as Nielsen. But the training and induction you had in that business, and I'm very old, close to 40 years ago, was just phenomenal. As an entrepreneur, you are selling stuff all the time, so you've got to have the ability to be able to communicate effectively, and good salespeople are relentless in execution. So look, my early days at VNU were formative in there's some extraordinary entrepreneurs who come out of that business of my generation.
How interesting.
Yeah.
Amazing. So shall we go to John and Sushil?
Sure, I'll go next. How do you define an entrepreneur? I mean, I've met a lot of entrepreneurs over the years. An entrepreneur, the classic entrepreneur, starting your own business, growing it, taking it to a certain level. What you see, you're absolutely right, Robert. I tend to find them wired a different way. The way of thinking is quite different. You need a lot of perseverance, grit, resilience. If you are starting on your own, you need an element of being a salesman as well, because what's the point of having a product if you can't actually sell it? But then along the journey, you then find a different type of entrepreneur. Do you call entrepreneur who comes in as a professional CEO then to grow it to the next level? Are they an entrepreneur? Yes, they are in a way, because they're beginning to take a business to the next level. What I would say, and I've seen this over the years actually, and I'm in my mid-40s now, I've seen, and there won't be any on this call, I've seen private equity, I call them friends, leave the corporate world where they've been managing portfolio companies and then trying to go off and do it on their own. And I can tell you now, those that have gone off, I could point at them and say, you're going to fail, you're going to fail, you're going to fail, you'll be successful. And partly it goes back to, again, Robert, the way you're wired. There's some people who think they can go off and create a business, but their brain is not wired the right way to actually be able to do it. That's my own just personal view.
Yes.
You're on mute, Shalini.
Thank you, John.
Yeah. I'm going to just say one thing, John. I think we should have another session sometime before the end of the year, looking at this whole thing. There's a very, very astute observation you've made around people leaving private equity to set up their own companies. and how you can pick on the ones that would be successful and wouldn't be, because it also goes on to the investment philosophy. You know, we're all investing in companies. How do you pick those winners? So I'd love to do another session. And Mummy, thank you for asking the question. I'm just going to ask Cecile to say if she's got a view, and because I know there's another few people before we've got 4 minutes left, I'd like to bring Demetrius in. And thank you for the comments that you've made to Tim, Robert, Cecile, and John on how amazing they are. This has been amazing. I'm conscious we're running out of time, and I wish we had a bit more time actually. So I'm just going to go on to Cecile. Mummy, you want to say something, and then I'll bring Demetrius on.
I'll voice of female entrepreneurship. So, I think as females, we need more role models in entrepreneurship. In my case, I was very fortunate that I met Anita Roddick at the time where she was running the Body Shop, and I was very young then, but she left a very strong impression on me. And I think that was that kind of later, many years later, gave me the impetus to go and create my business. So, and I think, for me, what I qualify as the most entrepreneurial is people who think outside the box. We don't go by the rule book. We don't listen a lot when people say it's not possible to do, and we push boundaries. And, that's probably my summary of what an entrepreneur is.
Yeah, just quickly want to say huge congratulations to all of you. And it's really interesting to hear you have to be wired. I will remember that. And before I go, Chandani and Tim, many congratulations and well done. You have done a great job engaging with the British Asian Trust. And I look forward to seeing you at some time, all of you. Thank you. Thank you, Bita.
Thank you, Demetra. Thank you, Mummy. And I'm going to move on, if I may. Demetrius, great to see you. How are you?
Very well, thank you. Thank you, first of all, everybody, for a very entertaining morning. I want to sort of maybe spoil the party a little bit, because I've had an experience of a capital event for quite a large organization where, because there wasn't agreement by the owners, which is a really important point. I mean, if you are a sole owner, you obviously rely on yourself, you have a good team, but in the end, it's your decision. When you have more than one owners, which quite often happens in businesses, because you have a partner and, the young friend that you went to university with 20 years later and quite a lot of money and responsibility is not necessarily the same person. Just to flag up the point that before you engage with John or people like John, who actually could be very helpful as an independent observer, it's really quite important to have some sort of consensus between the entrepreneurs. And if you don't, things don't go as well as they might. And I'd be interested in your comments on that. Yeah.
Right. Again, I'm going to relate this to a nice story, and this is one that goes back to probably 2005 or so, and everybody knows Money Supermarket, I'm sure. But Money Supermarket was founded by two individuals, but one of them was the boyfriend of one of the founders' sisters, and he was a developer. Developed the code, and at that time the internet was nascent, not really around very much. Gave away 50% of his business because he was making money elsewhere through kind of sending pricing via fax machines back then. But when it came to try to get to a capital event, you're right, Dimitros, massive problem at that stage of who was getting the money. At that stage, it was the boyfriend who had gone off into the sunset. He got all the cash there. He needed to make sure that the shareholders. We are accustomed. We've worked with so many entrepreneurs where you end up with 6, 7 different shareholders with all different agendas, and it's the job of, again, the advisor to make sure you can navigate them to get through to the transaction people are looking for. I encountered that last Thursday in a pitch, won't name the company, where it was very obvious around the table as we're pitching that there was a shareholder agenda, and I hinted at it, which the actually CEO called me up afterwards and said, that was very astute that you've noticed there's already an issue. But that's our job, to make sure that is navigated before you go on the journey of trying to transact something.
And from an investing point of view, that would be a bit of a red flag for me, as far as getting a feeling that not the senior management, some of them might be still in the business, some of them might not still be in the business. Having the senior management having skin in the game is key when I'm looking at investing in a business. Experienced senior management team, owned IP, trademarks, recurring revenue, barriers to entry, but senior management having skin in the game and being all on the same page is probably the most important one to me.
Thank you.
Tim, do you want to add anything?
No, all said, all said. Can't move forward without it sorted.
Yep.
Okay. We've got to the end. Unfortunately, I feel that this whole session has just flown by. What I wanted to say is that obviously there's a lot of people here who we've not seen face to face for a long time. If you did want to connect with anybody else on this reception, if you drop us a line, we will do that for you. We're going to send a thank you note tomorrow with the link that Ben Meckie's kindly sent. I wish I had more time because Tim, I've got a zillion questions to ask about the Trustpilot. So if you want to talk, if I may say, I think there's a few questions that's come into my WhatsApp. If they're happy to, I will
just connect them. Connect them. Yeah, it's fine.
Thank you.
Shalini, when are you planning, Shalini, on having the first E2E live event?
Yeah, so we're hoping to go back to physical events, and I can't wait for that in September. So I think we're going to wait for what happens on the 19th of July and what Boris Johnson says. But hopefully we'll start our physical events program. We've already got about 6 to 8 in the calendar for the months of September, October, and November with our partners. So probably the majority of them will be live, face to face. Hands up if you feel yes, you want to go, or do you prefer the virtual. So if it's physical, put your hand up, and if you prefer virtual, keep your hands down. So a lot of hands going up. Thank you. I can also see Amanda and Robin. It's good to see everybody. So we will go back to physical. As I mentioned earlier, we are working on the development of our match.com. We're hoping to launch the first version of that by September. So we will show you that. If you want access to any of our membership benefits, Ismail, Urdu are on the line. I want to just say quickly thank you to my team, because I come here and do the chairing of the events, but they do all of the hard work behind it and everything else that we do, which is much more than events. So thank you to my team. Thank you to some of the people on the call who've been our speakers. Lawson, we had a great event with you before Christmas. People still talk about it. So thank you for that. We're fundraising for some interesting companies. So if you are interested in investing, talk to us. Silas is here. We did an event recently with WaveTech. So Silas, thank you. They're doing a 45 million fundraise. And it's a very interesting batteries business. So anyway, I can keep going on, but I know I have to shut up. So I just want to say thanks to everyone. A huge thank you to finnCap, and delighted, John, to be working with finnCap. We used to have a good relationship with Cavendish, so it's nice to have a broader relationship now. Robert, Tim, Sir, and Cecile, you've been absolutely extraordinary. Really, really appreciate. Great to see you all, and thank you. Ask for the secrets. I think we've got a huge amount of learning here, and thanks again to everyone for joining.
Thank you.
Thank you. Bye.
Bye bye.
Thank you. Bye. Bye bye.